We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
That was Federal Reserve Chair Jerome Powell after announcing it would pause on raising rates for the first time after 10 consecutive hikes over 15 months. Now let's dive into the crypto markets with Bob Iaccino, co-founder and chief market strategist of Path Trading Partners. Welcome to the show, Bob.
Good morning. How are you?
We are doing just fantastic this morning. We're talking about the Federal Reserve. Yesterday, they also indicated that they would resume raising rates later in the year. Talk to us about how the market digested this. What are we seeing this morning?
Well, to be honest, I don't think, Jennifer, that the market's actually digested this yet, because it's one of the stranger decisions I've ever seen. Essentially, if I were paraphrasing, I'd say, yeah, we're not doing it now, but we're doing it later. And I don't really understand that, because what that signals to the markets is that there's a strong chance, despite the verbiage that said there's not a strong chance, that they won't do this later. When you looked at the summary of economic projections, the SEP, basically the majority of Fed members had another 50 basis points in this year. And I don't know why you pause or skip, as Bowman said, why you pause or skip if you're going to do it again. It seems to me to be more consistent, maybe do 25 and then sort of signal to the market there's another 25. But this particular Fed has said repeatedly, and Jerome Powell said at the beginning of his first term, that he wants to be more communicative and he wants to be more clear. And this couldn't be any more the opposite of that than to basically say, we're done, but we're not done.
So I was seeing a little bit of panic this morning. Like, people are like, oh, this is the beginning of the end. People are always saying that. People are always saying all sorts of stuff. But I don't know. You're not super worried about prices just tanking this summer?
No, I think the word crisis is overused. I mean, we just had a regional banking crisis, yet it was over in basically 10 days. And so I think the word crisis is overused. When you look at what the Fed has done, most people in my position think there's a 12 to 18 month lag time from where the Fed rate hikes actually take effect in the real economy. I'm not talking about the stock market. I don't care about the stock market in this particular context. But we talk about 12 to 18 months. That means we've only got about 100, 125 basis points that are currently affecting the market if it were a time-released sort of hiking cycle. Otherwise, we could potentially still be 3 or 4 months away from the bulk of these rate hikes actually hitting the economy. So if the Fed is waiting for these long and variable lags, as Milton Friedman called them, then you're talking about them not needing to do any more, in the very least, because we are seeing softening in the overall economy. I mean, you can see it very clearly in everywhere but the labor markets, and I would argue that the labor markets are starting to show it as well. Tech is always the first sector to lay people off. When you start getting manufacturing and services layoffs, services are always last. When you look at what happened to wages haven't really fallen at all. I just looked at the last batch of data, and the April data, the average hourly wage had been up about 6.4%, and in May it was 6.3%. And we don't have any data past that as of yet. But when you look at that, wages have not fallen. That likely means that people are going to spend. I was speaking to a friend of mine who owns a restaurant in Chicago, and he said his customers keep asking him when that $10 cheeseburger is coming back. I know, a $10 cheeseburger, right? But he said it's not.
Wait, is that a cheap cheeseburger or an expensive cheeseburger?
I also was like, I don't know. Is it cheap or expensive?
Well,
I'm just trying to understand.
Because now the cheeseburger's $20, and he said I keep having to explain that the $10 cheeseburger is not coming back because the cooks that were making $18 are now making $25. And when wages go up, you don't go into your employees and say, by the way, things are coming down, so I'm going to pull back a little bit on that raise I gave you. It doesn't work that way.
That's interesting. We heard yesterday that the Fed's going to hold tight on the rates as they assess additional information. to inform the next two rate hikes. What factors are they going to weigh when they're making these decisions, do you think?
Well, I think the number one will be the labor market in general. When you look at the trend in inflation, by the way, I always like to mention this. People think inflation is coming down. It's not. If you look at the last two sets of data, whichever one you want to pick, whether it's PCE, which the Fed looks at, or CPI, which everyone else looks at, you see that the month over month increases in prices, both core and headline, core being more important to the Fed, have not come down. They're flat. They're up 0.4%. Again, whichever one you look at, it's up 0.4. So people need to understand there's a difference between disinflation and deflation. Deflation means that the change in prices has a minus in front of it. We haven't seen that yet. So what you're seeing is a slower rate of growth of inflation. So based off of that, the Fed shouldn't be cutting rates. They might even need to do that extra 50 basis points. But they have a dual mandate. It's full employment and stable prices, somewhere in the range of a 2% increase in prices. Again, even their target is an increase in prices. So when you look at that and you see that we've gone from 3.4% unemployment to 3.7%, the Chicago Fed lists full employment based on their research at 4.1%. So there's still wiggle room there for the Fed to not only potentially raise rates, but to keep rates where they are for longer. Even if you had rates where the market is currently pricing them in at the end of 2024, which is somewhere in the range of 3.5% to 4.5%, depending on which markets you use to price it, you're still looking at the highest rates since 2008 for the Fed funds level. And there is a very large swath of people running companies now that were 17, 18 years old when that was the case. And I've never actually had to run a business with rates actually being high and money actually costing something. So there could be some worry there. And I think these kinds of things are exactly the reason you guys exist. When you have an activist Fed, whether it's here or somewhere else, that are doing other things besides just stabilizing the core currency, there's a need for decentralized currencies because of those actions.
And lastly, let's quickly hit on the crypto markets. We saw Bitcoin slip below 25K. Some analysts and traders are predicting that it could go lower based on price chart analyses. Where do you see the crypto markets going?
Well, I'm smiling because I kind of love what's going on, specifically with Bitcoin, which is really the main thing that I watch. It's the main thing that I'm invested in the crypto side of things. And for me, Bitcoin has held in. I don't care about these moves down to 20,000 or 19,000 or even 18,000. It would bother me if we got into four digits again. Then I would start to worry that the regulatory actions were getting aggressive and had teeth, because I think that's really the only thing that works. What I like seeing is, and this is for the asset itself, what I like seeing is the sort of undecided nature of the SEC, which illustrates more and more why Bitcoin specifically needs to survive. So I actually like Bitcoin here a lot. From a trading perspective, I have targets of about 31,700 and then to the upside, 35,120. So those are exactly where I'm looking for I'm trading it now. I'm no longer investing in it. I have those core positions and I'm keeping them. So from my perspective, this is a really good time to be involved. Bitcoin's back above its 200-day moving average, likely to stay there in my opinion. But if it doesn't, you have a built-in stop level for traders. You have a built-in add level for the buy and hold crowd.
Bob, thank you very much for joining us this morning and giving us some insight into what's going on in the markets.
Good to see you both.
That was Bob Iaccino, co-founder and chief market strategist of Path Trading Partners.